Welcome to the Exit Ready podcast. Ryan Ray here as always. Today you're going to love the episode. Be sure to never miss what's going on with the Exit Ready cohort intensive by going to www.rgahub.com/exitready. That's rgahub.com/exitready. I'll put a link to this in the description below so you can check it out. But if you're an owner, you're not going to want to miss this. Now, let's get to the show. Okay, I'm excited to talk to you today because the man who I call the Yoda of tax law recommended you. And so if he says it, then you must be like on the council of tax experts. Is that true?
Well, Josh is pretty amazing. Yes. But I do have a new expertise that in crypto tax. So I would love to talk to you about that today. I just want to make one disclaimer. This is for educational purposes only. I'm sure any tax attorney or any attorney you've talked to has said this, that this does not create attorney-client privilege, and please seek out your own attorney for specific advice.
But you said I had to Venmo you to be my attorney before we started. That doesn't count? That doesn't count?
I would
Oh,
be
you
your
mean
attorney.
Oh, you mean for everyone else? For everyone else.
Yeah,
Okay,
yeah.
okay, okay. Education purposes only. Insert disclaimer here. I got you. Do a quick intro so people do know who you are, what your background is.
So my name is Rita Abro. I'm a tax attorney. I've practiced for the past 20 years solely in tax. But I like to say that I like to explain tax in a way where I don't use jargon. I make it easy to understand for people. And my job is to educate and allow my clients to make decisions from a place of knowledge, not from a place of fear.
Okay, great. And for those who don't understand, because when I first met a tax attorney years ago, is because we had a sales tax issue, and I didn't even know that was a problem in the business we were in. And we had to get a tax
Mhm.
attorney to fix it. So they think tax attorney, I got a CPA. Like, why do I need to even hear from a tax attorney? Like,
Mhm.
aren't y'all only for certain things? Or so, what does a tax attorney do? And then what do you do inside that world?
Yeah. I mean, you can have a CPA and a tax attorney. Um, but in I'll just tell you that what I do. So I don't file tax returns. A tax attorney will not file tax returns, but a tax attorney will help you strategize, will help you interpret the laws. Like, for example, when you had your sales tax issue, and will basically give you the strategy that you need before it's even time for you to file your taxes. And then, most importantly, I like to say if you're ever audited or you have an issue before the IRS, a controversy issue, I tell my clients, I would, if you want to use your CPA, that's great. They know your numbers. I prefer to work with the CPA, but I think having a tax attorney to advocate on your behalf and somebody who knows how to advocate on behalf of their clients is a real winner.
Yeah, and what I've said is, so I was running a company for 15 years and I bought it. And then as soon as I bought it, the state came in and like, hey, you owe sales tax. And so it wasn't a thing to where we were hiding the sales tax. We didn't even know. I called my CPA. I was like, hey, there's tax here and in this other state. We didn't even know about this. He goes, well, I'm just a CPA in this state and I don't know. I'm like, yeah, okay, you're out, you're out, you're out. Sorry.
Mhm.
And luckily, because I had run the company, I knew we weren't being malevolent. It's a family-owned business. My father paid the sales tax because it was his bill technically. But I stress to owners, to buyers, and to owners, get this cleared up because you don't want this to happen to where you didn't realize, because we honestly just didn't know. In the
Mhm.
state that we're based out of, there was no sales tax for our services. So there's a lot of tax stuff that your CPA could have high integrity, could be great, but not know about some of this stuff. And so it is something that that you need to work
And
on.
that's exactly usually when you like that's why I say get a tax attorney, because the I'm the party pooper. I come in and I tell you what all the red flags are, everything that could go wrong, especially because I do represent taxpayers in audit. So I've seen everything that can go wrong. And usually it's not someone trying to pull something one over you. It's usually you just didn't know.
Didn't know, and that's what happened to us because we're just like, wait. And then the sales tax law in Texas is pretty stupid, for being honest. How they define it for what we're doing, at least. But anyways, okay,
And every
we're gonna
state
talk
is
about
different. So
yes,
then
every
try
state's different.
memorizing 50 state laws.
Yes, yeah, yeah, yeah.
Mhm.
It was we got it done. It turned out not to be that big of a
Good.
deal.
Good.
But if you're a new owner, you buy a business. Now we're talking about today something that's a hot topic because the word Bitcoin and crypto get thrown around out there. And we were talking the other day when we first met, and you were talking about companies being bought with crypto. And I was like, I never even thought about that. I mean, I'm sure it happens. I've heard of athletes being paid in Bitcoin and stuff like that. So let's define the term crypto. And then if there's a certain crypto that we're going to talk about mainly or not, or ones to avoid and ones that are in this conversation and ones that aren't, maybe define all that. Because if you go crypto, I've heard about it. I'm not even sure what all that means. Help us understand that.
Mhm. So cryptocurrency is a broad term. Like think of it as an umbrella, and there's so much that goes underneath it. Most of the time, when someone talks about crypto, they're talking about Bitcoin or Ethereum. Okay. Those are like, think of those two as like the blue stock chips of the NASDAQ, right? Very, everyone knows them. You know, you track the price pretty easily on an exchange. So then you have, okay, so that's like number one. Number two is we have stable coins, which are usually pegged to the US dollar. And those I say are kind of like, I don't know, like treasury bonds. Okay. Then you have everything else, which I call a lottery ticket. Don't go there. Only buy it if you have a high risk tolerance. Maybe you'll win the Powerball, maybe you won't. So when we talk about crypto today, what I'm really going to be actually referring to is Bitcoin, Ethereum, maybe stablecoin.
Yeah, and so if you're an owner, I talk a lot about attracting a premium buyer. And so a premium buyer might come to you with Bitcoin, might not. We can talk about that in a second if we need to. But if they come to you with some, Zootopia coin or something like that, unless you have a business that's really hard to sell and you can't get anything for it, super risky, probably shouldn't even look at that because the risk is too high. But we have to talk about earnouts and stuff like that. So if I'm thinking, okay, today we'll set the floor at $10 million acquisition price just to have numbers to talk off of, and someone says, okay, hey, I will buy your company for 8 million cash and 2 million Bitcoin, or 4 million cash, 4 million Bitcoin with a $2 million earnout in Bitcoin. Like there's a few ways this could happen.
Mhm.
What's the difference in accepting cash at closing at Bitcoin, no matter what the percentage is, and then we could talk about the potential for an earnout being tied to crypto later on. But what's like? How does that work from a tax standpoint if I accept cash versus Bitcoin or crypto today?
Okay. So imagine this. As you're building a business, okay? It's kind of like a movie. You have a beginning, you have a middle, and then you have the end. You've built this great business, you're ready to sell it, you're ready to be done. Close the book. You get cash for your business, you're done. You pay tax on, maybe, depending on how you're selling it, you pay tax on any gains that you made on the business, okay? If you accept something other than cash, if you accept some type of cryptocurrency, the IRS, the position of the IRS is that this is not currency, this is property. So it would be the same as someone saying, I'm going to give you a million cash and a million in Apple stock, or $1 million worth of my art collection. Okay. So now you're not ending your movie. You have a sequel, because now you have 1 million in cash and 1 million in property. You're the IRS's position is going to be, you just sold your business for $2 million. We're going to treat it as you have accepted $2 million in cash. So even though you have only $1 million in cash, you still have to pay tax on $2 million worth of a purchase price. Okay. So that's number one. And then number two is, when you sell the cryptocurrency, whatever gain that you make on that, you're going to pay additional tax on that. So it's essentially a double tax for sellers. And
Yeah.
here's what
Yeah.
I want.
Yeah.
Here's what I want your listeners to remember. As much as cryptocurrency wants to put itself out there as saying this is another type of currency for purposes of the IRS and for taxes, cryptocurrency is not cash, it's property, and it's going to be tax like property.
Okay. So I'm taking notes. So I'm gonna be slow to respond because this is a new topic for me. So this is
Please,
interesting.
yes.
So,
It's a new
so
topic for everyone. And by
yeah.
the way, anyone listening to this, even you today, Ryan, you're going to be more informed than 99% of the population after today because no one is talking about this.
And it's something that we will see. I'm sure people have seen these offers before, but it will become more popular, especially if Bitcoin and Ethereum continue to rise in popularity. Now, you did say something then that caught my attention. Okay, so we sell for $2 million, $1 million in cash, and $1 million in Bitcoin. It's treated as a $2 million acquisition, so I'm taxed on that. Now, you compared it to stocks a minute ago, and I've heard about stock harvesting, right? So let's say I sell for $2 million, and the Bitcoin plummets overnight. So that $1 million Bitcoin goes down to $500,000 in Bitcoin, and then I sold that Bitcoin. Is that then a tax harvesting play? That's risky. I'm not saying that people should do that, but just if I'm hearing that, I'm going, oh, okay. Or if the Bitcoin goes from that $1 million of Bitcoin goes up 500,000, now it's 1.5 million in Bitcoin. So how and then if I hold so if I hold it, I get that there's a $2 million value even if the price goes up or down. Is that correct?
Your
Until I
purchase price, no matter what,
okay.
is going to be, whatever the fair market value of, say, let's say it's Bitcoin, whatever the fair market value of the Bitcoin is on the day that you close, on the minute that you close, because the price of Bitcoin is changing by the minute. Okay. So, and then we can get into the details. But okay, so you closed for 2 million, 1 million cash, 1 million in Bitcoin. Hopefully, between the time that you set the price and the time that you close, it's still worth 1 million. So it's all going to be about like and this is why you would need a tax attorney. This is also why you would want to charge a premium for your business. If you're going to say to your buyer, "Hey, I'm selling my business for 2 million." And they're like, "Great, I'll give you 1 million cash, 1 million dollars worth of Bitcoin." Okay? You might say, "Well, I'm taking a huge risk accepting the Bitcoin. I will do that, but I need a 30% premium on the purchase price consideration because now I need a tax lawyer who understands crypto. I need a financial advisor who understands crypto, and I'm offloading a huge risk. You're offloading your risk onto me. Why don't you just sell your Bitcoin, convert it into cash, and pay cash money to me?"
Okay, so let me ask a dumb question then. Someone comes to me and they say this, I want to do a million. Could I go to them and say, okay, hey, this is a huge risk. The Bitcoin could go down, it could go up. I don't know what's going to happen. The cash, I kind of understand, barring World War III breaking out, what the value of that's going to be. Can I just say to them, you mentioned one option, but is it possible for me to say, okay, hey, I'm gonna call my tax attorney, I'm gonna call Rita up and get a price of my tax bill for next year? Can they just pay that tax bill for you to eliminate some of that risk in case the Bitcoin goes up or down? Is that something that you can negotiate with that?
You can have a tax gross up, you can have a guarantee, you can have a floor. There's lots of things that you can do. Let's back up for a minute. So, why would you want to accept a cryptocurrency like Bitcoin? Okay. So, let's say this is the first business that you've ever sold, okay? And you're 30 years old and you know that you're going to buy and sell more businesses. But say you need the cash from this business to fund your next business, okay? You're probably not going to want to accept Bitcoin. Say this is your 10th business and you're 65 years old, you've already sold 10 businesses. You have you're okay. You don't need the liquidity. And you're interested in crypto, you want to own some Bitcoin. it's all going to depend on the individual seller's risk profile, risk tolerance, and liquidity needs.
Okay, so we get this $1 million in Bitcoin, and just to make this a little bit easier, we close on December 31st, right? So the tax bill is set. Okay, so we get the
Good.
minute. Okay, just to make
Yeah.
this easier. Okay, so so coming in 2026, we're recording this in 2024, 2025. So 2026, we say, okay, this is our tax bill. So if I'm hearing you right, what you're saying, I think, is if you sell for 2 million, whatever your tax bill is before this liquidation event, you need to have the cash to cover the tax bill without selling the crypto. I'm sorry, you
Hmm.
put the two up. Yeah, yeah,
Yes, for 2 million. Yep.
yeah. For the 2 million in
Hmm.
2026 or 2027 or whatever this is,
Yeah.
you're listening to this because you're going to pay cash on that. Because if you did a close at 9 a.m. on the last day of the year and you got 2 million, and then you sold the Bitcoin 5 minutes later for the cash value, what happens then? Because that's a different tax event, right?
Hmm. If you sell it, if you sell it for 1 million, which was the fair market value at which you got it, then there's your cost basis covers you. There's no gain. You're done. What I would worry about is if you got the 1 million in Bitcoin on the last day of the year and the next day it plummets. The IRS doesn't care. They don't care that it's not worth any money today. They care that it was worth money on the last day of the year when you accepted it. But if you don't have the money and you don't have the liquidity, you have a huge tax bill you can't pay.
And you can't pay the taxes in the Bitcoin, correct?
Cannot pay taxes in Bitcoin. I looked it up but right before we started just to be
Okay,
sure.
I've heard the Bitcoin people talk about some of that stuff, and I'm like, okay, I'm not a. This is I am a complete idiot here. So please, I have no clue.
You're 99% more educated now than you were than the general population. You're good.
Okay, great, great, great. I'm still an idiot. That's fine. Okay, so I get this $2 million, a million Bitcoin, a million in cash, and I need to have the cash in hand or the risk tolerance to understand that if it plummets before I sell it to pay the tax bill, the IRS is not going to go, oh, well, we get that you sold on January 3rd when it started to fall. Oh, we get that. They're going to say, no, your bill is capped at that $2 million mark. And
Mhm.
so you are locked in there. You can't roll this into any kind of IRA or it's just like accepting cash. Now you mentioned other types of people might pay in. I think you said art or stuff like that, or stocks or stuff like that. And real estate comes to mind. What if they said, "Hey, I'm going to give you some real estate that's worth. I have it appraised. It's worth $2 million." That's the same type of mentality as the crypto. Is that the same?
Okay,
No.
so actually this is really interesting because remember the 2008 crash?
Hey, quick break here. If you're an owner, do you know that most companies will never actually sell? That means that all those years that you put into building your business are for nothing. If you want to build a business that's valuable, that people will want to buy, and you can make potentially millions of dollars from, go to rjhub.com or click in the link below. That's rjhub.com or click on the link below. And now back to the episode.
Okay. So what happened in the history just repeats itself. So what happened in the 2000s is that there were some deals where where buyers were saying, "Let me give you some real estate as part of the consideration." Okay, or there's some kind of rollover, and this is what buyers were saying: real estate never goes down in value, only appreciates. It's better than cash. Okay, then 2008 happened. Okay, and everything crashed. But it's the same exact thing. You sold your business for 1 million cash, and then a building, say that was fair market value, 1 million. Okay. You sold it on the last day of the year. Then say you sold it in 2007 and 2008, everything crashes. You still owe $2 million. You still owe tax on the $2 million for which you sold your business. even though your property is worth nothing now.
Okay, so yeah, this is why you need a tax
What?
attorney because it's like, oh my gosh, this is crazy.
What? What did you wait? What did you
I said
say?
this is why you need a tax attorney because it's like, oh, okay, this is so risky. It's really crazy
No,
and
listen, it happened. Okay, I was too young to remember this in the 90s, but I've done some research. So in the 90s, it was like stock options, right? Like sell your company and we'll give you some stock options in the new company that's buying it, okay? And the company's going to be worth millions. Like why do you even want cash? We're going to do an IPO. You're going to make so much money. Maybe, and then you have like the tech bubble and everything popped and now you have nothing. It's like, okay, so it's like three questions. It's like, what's your risk tolerance? What are your liquidity needs? And, you know, how, like, why are you allowing seller to shift the risk to you? There has to be some type of benefit to you, right? For the risk to be shifted. Unless you're really interested in crypto,
yeah,
unless you think you can hold it for the next 5 years, for example, because it
yeah,
goes through like Bitcoin especially, like goes through like a 4-year, 5-year cycle, okay? If
yeah,
you think you can hold it for that long and you don't need the liquidity, it might be a really great
yeah,
investment that pays off.
right,
But you have to ask yourself, and then the other question is like, you know, um, do you if you have a business and you want to open up the demographics of who can buy your business, you might want to open it up to somebody who can pay in some type of cryptocurrency, right?
hmm hmm
But if you don't, then sell your business for cash, and if you really want some crypto, buy some crypto in cash.
yeah, and that's kind of the theme here I'm hearing is you mentioned that holding the Bitcoin halving in the 4 year, you're projecting into the future that trend is going to continue, and that the tax laws around Bitcoin and crypto will stay the same. They might change. I mean, I don't know.
Oh,
You're
I guarantee you that they will change. So right
right.
now, we have a lot of leniency, but the regulations are coming and they're just going to get stricter.
Yeah. Well, that's what I was saying. Like everyone talks about, forming your LLC in Delaware because all the case history, and it's like, okay, yeah, I get it. Some companies they might need that. For most, probably not. But the thought process is they've had so much LLC experience, they kind of know what's going to happen here, there. With crypto,
Mhm.
we don't have that experience as far as how the IRS is going to rule, what they might change. I'm not going to get into the politicians, insider trading, and stock, how they might. But the winds of that will change based upon public sentiment, right? And so you're very, with cash, you at least kind of know where there's a history there, kind of like the Delaware mindset. There is a history of how they should treat this, and you kind of know what the value of the cash will be, barring some kind of crazy event that if that event happens, you just don't know anything. Like all the rules are thrown out. So with cash, you kind of have this history of going, okay, this is the tax range we've seen the last 20, 30, 40 years. With crypto, we don't have that. It's so new that there is the risk of what's it going to do in the future. And then how will the government tax it and treat it in the future? Because right now they don't treat it as cash. What do they treat it as?
It's property. And I think that is what is confusing for buyers. I mean, for sellers is that yes, it's supposed to, it's cryptocurrency, but it's not currency. It's property. If you're not willing to accept someone's art collection as part of your purchase price, you don't want to accept cryptocurrency. And it is new, but the concept is not new. The concept is as old as time. It's in the 90s, sellers offering stock options, sellers offering real estate. Okay, so even earnouts are speculative, right? You don't know how the business is going to do in the hands of a new owner. So, you know, how much risk are you willing to take? There's a reason that we stopped bartering in this country and we use cash because
Yeah.
cash is king. The deal is closed. You know the value. You're done.
Is it true to assume in today's environment that if you're going to sell that and they pay with cash, it's safer to assume that they have the cash than if they have crypto or the crypto securities, like if someone transfers crypto to you, Bitcoin, Ethereum, or whatever, that they actually own it, they didn't hack a wallet and send it to you? Like, is that a one-to-one or is it not a one-to-one?
So that's a really good question. So yeah, so that's the other thing is like, let's say I do accept it. I'll take your Bitcoin. That works for me. Okay, now I have to set up a wallet, a digital wallet if I don't have one already. I have to make sure that the buyer actually owns the Bitcoin. Okay. And then, so like with money, US dollars, for example, you're going through a bank. You have certain types of insurance, certain types of regulations to protect you. There is no protection here. If seller sends, if buyer sends the money to a wallet, because a different wallet because they missed one letter in the wallet address, you're done. Your money is gone. There are no protections whatsoever.
So it's not just the value of what the Bitcoin might be the next day, next
Mhm.
hour, next year. It's also the protection of making sure it lands in your wallet, which is
Yeah.
which is scary to think about.
Have you seen the wallet addresses?
Yeah, they're crazy long.
I have like now in deals, like people are worried about like when they do um a wire transfer. That digital wallet is even is and I don't want sellers to say, "Oh, this is too confusing. This is too hard. I don't want to do it. I don't understand it." I want them, if they want to say no, to understand why they're saying no. If a seller wants to accept cryptocurrency, they can. It will just take more work and they need to hire the right experts to make sure that everything happens correctly.
Well, and you said it well earlier. It's about risk tolerance, and that's one thing I stress to owners is you want all cash on the day of closing. Well, the valuation is going to go down, right? You might get someone who wants to offer you a Bitcoin in this case or Ethereum in this case because they're looking at the different. If you say, well, I'll take less cash and a small owner financing, that's different terms. You really have to understand what your risk tolerance is. And I don't say that flippantly. I mean seriously, because as you understand what your risk tolerance is, what kind of buyers you can attract with that risk tolerance. Like if you're super high risk, you can attract some people that might give you some, Zootopia coin or something like that. Because for them, they're like, yeah, sure, I got this stuff, and it went up. Because if we remember back, if you're on social media, you will see these coins that will pop up, and all of a sudden overnight they're the meme coins or whatever, and they're going up in huge value, and people are making a lot of money off of that, and then they tank. It's like, what? Wait, so if you sold your business off of some meme coin and a bunch of Twitter posts about this thing's going to the moon and all this stuff, well, you might find out that you sold for 2 million, and that $1 million of Zootopia coin is worth nothing now, and so you got $1 million cash. Your tax bill is worth 2 million, and if you don't have the cash king, the IRS doesn't care, and so it's about that risk tolerance. If you have the cash, you're like, I'm willing to risk it. I think this thing's going to go up good, great. But if you do sell the coin, so if you had $1 million of this coin value and it goes up to 2 million, it doubles in value, and then you want to cash that out, that's a new tax event, right? It's that new $1 million you owe taxes on. Whereas if you had the cash, there's inflation you got to figure out. But if you invested that with your IRA, that's a little bit easier to figure out how it's going to work and what the tax events along that might be. But if you get panicky going, oh, and if you talk to IRAs, one thing they say is the hardest thing for them to do is to keep their clients invested in stocks when the stock market gets choppy. They want to sell. They want the cash. Well, if you're in a
Mhm.
stable coin, then or a meme coin, if we want to say that term, the pressure's all the more high because you don't really know how long this thing is going to hold its value. So the temptation there is going to be to sell it, which then creates a new tax event because now you've raise your income level from that. And so that's one thing that probably gets lost from a seller's perspective is like, oh, I'm going to hold this and see what happens. Like, well, the industry experts say that from a stock perspective, which blue chip stocks are way safer than this stuff as far as just what they're
Mm-hmm.
going to do, you're likely going to sell it, which means you're going to sell it and then potentially create a new tax event or not have enough cash to cover your old tax event.
Mm-hmm.
It's a double.
Exactly.
It's a double-edged sword.
Yeah. And like you said earlier, I mean, it's about how do you want to structure the deal? You know, you want 100% cash? Do you want 80% cash and, 20% in an earnout or an option? Um, there this isn't it's not anything new. It's just a different form of payment. But what I want your listeners to remember is cryptocurrency is property. It is not cash.
Now, I want to be clear here, make sure I'm following along. There is no hold period that you have to hold it for, right? So if you close today, you can sell that 5 minutes later, and then depending on if it went up a smidge or down a smidge, there might be a little bit more taxes or no extra taxes. But you don't have to hold the crypto for any special time for this tax that you're talking about to happen. It's strictly tied to the time of the
Mhm.
close, right?
Mhm. Exactly.
Okay. So if I'm going to market and I want to sell, and someone comes to me and says, "Hey, yeah, I want to pay you $1 million in cash and $1 million in Bitcoin. We'll say use Bitcoin for this. Want to close in the year." If I heard you correctly earlier, odds are you should ask for a premium because you're saying that that could drop. Like, why should you ask for a higher premium if they sell in Bitcoin?
Well, you're taking on additional risk. So, like you said earlier, if you are selling your business and you say I want 100% cash, the price might be a little bit less. If you say I want 50% cash and I'll take 50% in crypto, well, now you're taking on more risk, okay? And you're shifting risk from the buyer to the seller because now buyer's offloading his risk of what Bitcoin could be worth on day of close to you. So you should be paid to hold that risk. Number one. Number two is if you say, I will take $1 million of Bitcoin, what are you have to be very clear about what you're actually saying, okay? So, um, how many Bitcoin do you need to in order for the value to be 1 million? The price of each Bitcoin is changing by the minute, okay? So then you will want to structure your deal to say, um, the number of Bitcoin, you know, and then the value that the Bitcoin should be worth, and then some kind of floor. Like if the Bitcoin goes below this, deal is off. Or maybe seller would be like, if Bitcoin goes above this, deal is off because I'm not giving you that much Bitcoin.
Okay, and so the risk is the tax. So you got to understand that the value you can't control the tax, but at least you know what that is. The value you honestly have no idea what's going to happen. You might think it's going to go up, or you might think it's going to go down, but we don't know. We just don't know. We don't know. Just like any stock, it can do whatever it wants to do. And so the tax, there's a risk you can calculate and figure that out. The value you don't know. What if someone said, okay, hey, I'm going to take $1 million cash, $500,000, I'm sorry, 1.5 in cash. I want to earn out, but I want that in Bitcoin, 500,000 in Bitcoin. Like as I'm looking at it right now, the price of Bitcoin is 87.5. Okay, so 87,000 we'll say is the value of Bitcoin today. The earnout's over 2 years. How does that tie into a tax problem? Is that only with does Bitcoin change that? It's tied out when you get the Bitcoin, or does that change anything from an earnout perspective?
Okay, so you're gonna accept five. So you're gonna accept 500,000 in an earnout, and the earnout will be paid in Bitcoin,
Yes, exactly.
right? So then you'd want to structure your and then how is the earnout structured? One Bitcoin a year or $100,000 over the course of 5 years?
Let's just defer it all to the end. So like they got to hit certain marks, and then they get the
Mhm.
earnout in full
Mhm.
at the end just to make this and that. If you don't understand why she's asking these questions, because it's all negotiable. There's so many variables to your, and so I'm trying to make it simple. And I appreciate your questions, but for the listener going, wait, why is she asking these questions? Because you can structure it a lot of different ways, and understanding all of this really is really important. And I always talk about M&A. It's a high stakes game, and if you don't appreciate that, you're going to leave a lot of money on the table when you go to market or when you sell, because you just didn't pay the money to figure out what's going on and how to think about that stuff and understand you might have your internal risk, but if you miscalculate, you say, I'm really risky, but you didn't realize that your risk was 100x more than you thought it was. That's a problem. This might be a way that you go, oh, I'm really risky, so let's put the earnout at the end and say, okay, whatever. So
And
Bitcoin's
let's say,
87,000. Go
okay,
ahead. Go
no,
ahead.
I like this
Yeah.
question because this is why you need someone in M&A to help you, because you can be so creative with the structure. The more creative you are, the more risk you're taking on, the more of a premium you can demand for your company. So say I want an earnout, and you can either pay me $100,000 worth of Bitcoin per year, or you can pay me 500,000 over the course of 5 years, or you can pay me $500,000 at the end of year 5 if we hit all our marks, okay? I would argue if now essentially what you're giving seller is the potential to hold $100,000 each year that they don't have to pay to you, that they can reinvest in their company, that they can simply invest, right? And they don't have to pay it to you until year 5. So I would ask for a premium on that, on the rest of my purchase price, number one. Number two is you can even structure it to say, well, don't pay, don't, not in year 5, in year 6, because in year 6, well, this might not apply for, because it's not income tax. Um, say you were getting cash in year 6, I'm retired. I have no income, so my tax bracket is going to be lower. Okay. There's so many ways to structure it for your benefit that honestly are really fun and exciting to talk about. And it should be fun and
Yeah.
exciting to
Yeah.
talk about selling your business. Like, you've poured your blood, sweat, and tears into this, and it should be fun. It shouldn't be boring. It shouldn't be scary. It should be exciting, and you can be creative. Okay, but let's go back to your question. So, if we get Bitcoin in year 5, then we would want to say we want $500,000 worth of Bitcoin. We're not going to say we want 5 Bitcoin, because who knows how much each Bitcoin is going to be worth at that time.
And let me pause right there. That's a key distinction, because
Mhm.
if you say you want 5 Bitcoin, theoretically it could be worth way more than 500,000 or way less than 500,000. So going back to
Yes.
risk tolerance, you might say,
Yes.
I am super bullish on Bitcoin. I want to do 5 Bitcoin. Understand that it might not be worth $500,000, or it might be worth $2 million. You don't know, but that's that risk
Mhm.
tolerance thing. And so go ahead. But I just want to pause there, because it's it's a thing to where, oh yeah, I want it in Bitcoin because I assume that Bitcoin is always going to go up, and it's not. If you think about the halving events and stuff like that, you can try to time all that stuff. But on the day that you set the earnout to hit your account based upon these markers, it doesn't mean that that day those 5 Bitcoin will be there. You might have missed it by a week, and so
Mhm.
5 Bitcoin could have cost you a lot. And so, anyways, sorry, go
Mhm.
ahead.
No, yeah, that's a really important distinction. So you could say, I want 5 Bitcoin, or I want $500,000 worth of Bitcoin. That could be 6 Bitcoin, or it could be 100, right? But so it's all about how you structure the deal and how you define your earnout.
So I, this is a guess. I'm guessing the older generation, the boomers, as we like to call them, they're probably going to push back on selling in crypto and stuff like that. The younger generation is going to be more bullish potentially on some of this stuff and more open to this. What advice would you give to both demographics? Just about thinking through this. You touched on it some earlier about selling, multiple companies and where you're at with your life. But right now, you're 45, you're 55, you're 65, you're 75, kind of, the younger generation versus older generation, thinking about selling, looking at potentially selling with Bitcoin to someone who wants to buy Bitcoin. Uh, Older, younger, does that weigh into this equation at all?
Yeah, actually, it really does. So if you're older and you're getting ready to retire, your risk tolerance is just naturally going to be lower. Okay. Maybe you don't have 5 years to wait to see if Bitcoin will go up if it happens to go down. Okay. But you also don't want to alienate a buyer who otherwise is giving you a really great purchase price for your company. So, what I would advise is I would say, okay, instead of saying, no, I'm not accepting anything at all, say, I'll take 95% in cash and 5% in crypto. Okay. And then you can negotiate some protections. So, for example, if by the time of close, the value of the Bitcoin goes below this price, deal is off, you have to pay cash. Okay. Um, you can require that the Bitcoin is placed in an escrow account between the time, you agree and the time that you close. There are different protections that you can have. But if you are older, I will say that your risk tolerance is going to be lower, your liquidity needs are going to be higher. And if you want to say no, but say it from a place of knowledge and not from a place of fear. And you're going to come across as more sophisticated to the buyer, and you're not just saying no because you don't understand it. You're saying no because you understand that crypto is property and it's not cash and it's not a risk that you're able to take right now.
Yeah, and I think that when I'm talking to owners, it's risk tolerance comes up. You got to understand this, and it sounds kind of cliche, but this is real money. We're talking about a couple $1,000,000. We're talking about it pretty flippantly here because it's a podcast. We're just kind of chatting about it. But $1,000,000 or $2,000,000 in your account versus a wallet for Bitcoin, that's real money. And unless you're Bill Gates or Elon Musk or someone like that, a couple $1,000,000 for just about anyone else does a lot for you. It really gets you down the
Oh,
road.
but don't be fooled. Elon Musk and Bill Gates, they also tax plan.
Oh, yeah, yeah. I'm just saying this. Just
Yeah.
for them,
Yeah.
they might buy something for $1,000,000 because it's a Tuesday, but for everyone else, $1,000,000 or $2,000,000 is a big deal. It really is.
It's what you've spent your life building to come to this moment. So, you know, they can sell their Bitcoin and pay you cash.
Okay, and you've mentioned that a few times. Okay, so if I'm a buyer and I come to you and I said, "Hey, I want to buy 50% cash, 50% Bitcoin," and you told me to sell my Bitcoin and pay me in cash, would I be likely to say to you, "But that's going to cost me more in taxes because I've got to sell now"? So theoretically, I bought Bitcoin at 30,000. It's worth 80,000 now. So when I sell, it's going to cost me taxes. So does that come into the equation at all?
That is a really good question because uh, the rules on when Bitcoin is taxable are very fluid at the moment. Okay. So technically, the IRS could come and say, and this this conversation is is geared towards sellers, but if you have a buyer, I mean, if they are offering their Bitcoin to someone
It's
else,
yeah, to be clear,
yeah,
it's more you've said, "Hey, buyer, sell your Bitcoin and pay me cash." And I'm saying if the buyer says back to them, "Well, that's going to cost me more in taxes," what might you say to them? I understand there's a lot of stuff that you don't know about this buyer and whatnot, but they could just fire back, "Well, that's going to cost me a bunch of taxes because I bought it really low. I'm selling for this." So how might you just respond to that? That's
it's
that
going to
makes
cost me
sense.
the same.
Yes, it
Yeah,
costs you the same. Okay.
gonna cost me the same amount of taxes.
Okay. Yeah. So yeah, you got to pay taxes. I got to pay taxes. We're all gonna pay taxes on this. So
Yeah.
you're asking me to pay taxes, and I think that's kind of the point I was getting at is they might say back to you, "Well, it's gonna cost me a bunch of taxes," and you guys say, "Well, I'm gonna liquidate this Bitcoin. It's gonna cost me taxes, right?" Or I gotta pay taxes if this goes down, and so understanding the negotiation of why you're saying that, what they might say to you, and then coming back and say, "Well, okay, you're asking me to pay cash to the IRS, not Bitcoin, on $1,000,000 in Bitcoin in this analogy here." I got to liquidate it to
Yeah,
cover that.
what I was trying to get at is, either way, they're going to have to pay taxes on it. Whether they sell it and convert it to cash and then buy your business, or whether they use it as consideration, either way, they're going to have to pay taxes on it.
Okay, I don't want to get too deep into the stock sale versus the asset sale, the stock of the company, not stocks, but stock of the, equity sale or asset sale. Is that relevant when crypto comes into mind?
Now you're going to have to pay an hourly rate for this.
Wait, I've Venmoed you already. I got Cash App you now.
Now we're getting into the weeds. I don't know if I can give that advice for free.
Okay, maybe reach out to
No,
Rita. There we go.
I'm joking. I would no. That takes some analysis. But it's a very good question.
Well, it goes to the heart of some of these M&A deals where buyers want to buy a certain way. You touched on earlier, you might can sell your company for no taxes. We're not going to get into that today, how you would structure your company for that. And it's just, there's always questions about how to do this. And it goes back to risk tolerance and what you know. And the hardest thing about M&A from a seller's perspective is a lot of times I've been told by owners, bring me an offer from a buyer. I'm like, well, that's you don't want that. You don't trust me. You don't want a buyer to bring you an offer because how do you know it's a good offer? Or it might be a good offer and you might be way overvaluing your company and reject it. And then by the time you go to market, you're not worth that anymore. And so you don't really know. And so if you're doing in this world, it's the same thing. Well, stock sale, asset sale, getting Bitcoin, cash, taxes, all this stuff. And I think I don't like hating on other people, so I'm not hating anyone. There's a lot of education right now for buyers on how to buy companies for no money down, little money down, 100% owner financing, and I can foresee a future where there's a lot of advice on how to buy with crypto, and owners won't know. Oh, wait, I got 2 million in crypto. I wasn't expecting a tax bill at all, and the IRS like, no, that full $2 million acquisition that you sold, it's all taxable at $2 million. Where's the cash? And they're like, well, I haven't cashed it out. It's worth half of what it was. And they just didn't know that was something that they should have considered, much less a stock sale versus an asset sale.
That's exactly right. Yeah. And something that you said earlier was so interesting is like, you don't want somebody to just bring you an offer. You want to dictate the terms of your deal from the beginning, because you know what's going to be a good offer and what's not. And there are so many ways to structure it.
Okay, I know we're up against the clock here. Do you have a few extra minutes? We were late getting started
Yes.
because of my fault. Okay, I didn't want to thank you for that. I've seen some companies
Time flew by so fast.
I know, right? I've seen some companies that are paying employees with Bitcoin and stuff like that. Does that change any of these equations if you're already paying your employees in Bitcoin and your company already transacts that way? Does that change any of this?
I mean, it's different because if you're paying your employees in Bitcoin, then that's income tax to them. I would say no. I would say no. It does
And
not.
the reason I'm asking is because we've talked about this before. Me and Josh talk about this a lot. You will see, somebody online, the Wyoming LLC is the big rage right now, and there's some tax. So you will see people, and I'm not saying I've seen this. I'm just making this up. If you pay your employees in Bitcoin, when you sell your company, the taxes are less because of so and so and so and so and so and so. And it's like, well, wait, hold on. Does that matter or not? Until owners start, giving bonuses or paying in Bitcoin or funding IRA, their 401ks in Bitcoin. You can see potential for people selling packages where if they use crypto, that somehow when they sell their company, it's deferred taxes or less taxes. And so at the core, though, it doesn't sound like that's going to help you if you accept crypto when you sell by restructuring your company and how you pay your employees today.
No, because you're paying them in property. You're not paying them in cash because crypto is property.
Yeah.
But remember this. Here's the exciting part is there's a huge demographic of young people, mostly young people, some older, let's just say there's a huge demographic of people who have made a lot of money in crypto. Okay. And they're looking to invest their money. And that's a huge pool of potential buyers for your company. Okay. So you're saying I will not accept 50% crypto for my company, but I'll accept 5%, you know, and I'm going to charge a premium for that, a premium price. You're opening yourself up to a huge new demographic. Okay.
Yeah.
There's yacht companies now who are accepting Bitcoin.
Yeah.
Why? Because otherwise they wouldn't have these customers.
Right.
So it's exciting, it's new, it's offering a whole new potential. It's not going away. It's here to stay. So make yourself knowledgeable about it. Say no from a place of knowledge, not from a place of I don't know and I don't want to take the risk.
Right. So if I'm summarizing what I've learned here today, is first you got to understand what the risk is. Risk tolerance is important. But you got to understand what the actual risk even is for this type of transaction if you're going to include crypto. Two is that the IRS hasn't really fully had enough time to understand what it is. So if you're going to push it out for a long earnout, you're taking a risk not only on the value side, but what the IRS might rule in the future. It might be in your favor, it might be against your favor. Three is don't buy a course that's like, hey, we're going to set this up for you. Here's a package of documents, and it's going to
Please
eliminate your
don't do
tax.
that. Please don't do that. I beg you.
And I haven't seen that sold, and maybe there is someone selling it. I'm just saying that I've talked to you and Josh and other tax attorneys enough to know that some of the advice that's out there about they're going to sell this package, and it's not really good advice. The biggest thing I would say for owners is, and I mean this in all sincerity, is that owners, if you listen to marketers, let me step back. If you listen to marketers say that people want, sorry, people want speed and they want it done really fast, right? They want speed, they don't want any effort, they don't want it done fast. And so when it comes to tax planning and stuff like that, people will sell you solutions to your potential problems that are fast and don't require a lot of effort. But a lot of times, the nuance that you need for taxes is not that. Like, that's not the game that you want to play when it comes to taxes,
Well,
especially here.
yeah. Listen to what we talked about today. It's about what your owner's risk tolerance is, what your owner's liquidity needs are. Okay. So one price fits all tax package is not going to work because they don't know the owner. They don't know what risk they're willing to take and how much liquidity, what the liquidity needs they have. And they don't know you. And also, they don't know if your spouse is going to stop talking to you at dinner if you said, hey, honey, I sold our company for Bitcoin, you know? So there's so much that goes into it. It's not just numbers, it's not just boring tax law. Okay. These are people's lives.
Yeah, I can imagine that going really well. Hey, honey, I sold the company for a couple Bitcoin, and the wife goes, let's go buy a new house. You're like, well, if I do that, the price went up. There's more taxes. I don't really have the cash. So would you sell it for? Well, it's this Bitcoin thing. It's really great, but
Yeah, you're sleeping on
we
the
can't.
couch.
Yeah, we can't benefit from it because the local shops don't take Bitcoin, and so it sounds kind of silly as we're kind of joking about it. But those are the real conversations that happen when you go to exit.
Right. Right. Now, what if you say to your wife, hey, honey, or you say to your husband, I sold my company for, $2 million in cash and 5% Bitcoin. That's the only way I was able to do it. But we have $2 million in the bank. Maybe we'll have another 2 million in 5 years. Great. But just know what you're talking about, know the offer, and know all the risks and the benefits.
Yeah, owner financing and earnouts are risky. They are required a lot of times, and so I don't want to say like you shouldn't do them and if you want all cash, you're going to lower that value. So they are risky. You are going to have to do some of it more than likely. Depending on how you want to sell, you might want to have a higher earnout because you're getting that second by the apple on them, not getting all that. But understand if you're going to increase the amount of crypto you take, then you've just increased the risk that you're bringing to yourself, and that's something that you had to sit down and really think through. And it's so hard as humans, and I know we got to wrap up, so let's wrap up here. I've learned this myself. Is I will say that I want something, and then I get it, and I complain about it, and it's like, wait, this is actually what I wanted. I said I wanted this. I just didn't think through all the implications of what this would be like, and so now I've got this one thing over here that's nagging me. It's like, well, I said I wanted this thing, and now it's like buying a boat, and there's always problems with the boat. It's like, well, you said you wanted a boat. That's part of buying a boat. So here, if you want to exit your business, you really have to think through the post-sale lifestyle that you want, how cash plays
Mhm.
into that, how crypto and taxes and all that stuff plays into that. And do you want the stress? So if you're going to retire and never work again, do you want the stress of having to check the Bitcoin price every day, every week, every month? Do you want that stress or not? Maybe you do. Maybe you love that. Maybe that's what gets you going in the morning is like checking that stock market. I don't know. But if you don't, you never want to check it again, then maybe that's not the path for you. So, okay, if they've heard this, they go, oh, okay, I'm not sure I want to do Bitcoin or not, but I want to learn more. Where should they reach out to talk to you to learn more?
I'm on X, or formerly Twitter. So, or you can go to my website and send me an email. So it's rdabrolegal.com. And my Twitter is just my name, Rita Abro.
Okay. Well, thank you so much for your time. I'm an idiot on this stuff, and I don't want to. I always
You
tell
are,
people.
any owner would be lucky to have you help navigate them. You are, and you explain things so well in a way that anyone can understand. And these are it took me a while myself as a tax attorney to understand earnouts and
Mhm.
the way how to structure a deal. So you're doing amazing, and any owner would be lucky to have you.
Well, you were too kind to say that. I'm just a redneck from, well, I live in Texas now, but from Louisiana. So I'm just a redneck. I always say I talk redneck to redneck, whether you're a redneck or not. It's just, that's what rednecks do. So that's all we can do. And so thank you for
Well, let
that.
me give you one line for your owners.
Please do.
Cryptocurrency is property. It is not currency.
Okay. Yeah, I love that line because that is a great reminder that,
Mhm.
because we think about, especially if you, and this is the key thing here, is that if you get online on X, like everyone talks about EBITDA, EBITDA, EBITDA. Well, most owners don't know what EBITDA even is. So great, you know EBITDA, cool. But you talk to an owner, they're like, well, I've got two lake houses. Is that EBITDA? You know, like that, and I'm not making fun of them. Like, you got two lake houses, good for you. You know, that's what you should care about. The same thing here. Bitcoin going to the moon is great. Well, it's you know it's property, not currency. Oh, you need to hear that over and over and over again because you have to rethink how you think about it. It doesn't matter what you think it's going to do. It matters how the government's going to tax you on it. Whether you agree with that or not, it doesn't even matter. It's what they're going to do, and you've got to live within those rules. So we play the game within the rules as they're constructed, whether we agree with them or not. And so it's a great reminder. So thank you for that. And oh, final thing. I know you said that you told me when we first talked. There's a new forum or something coming out next year. So this isn't tied to M&A per se, but people that might have crypto. There's some new tax stuff coming out. Maybe
Yes,
close with that
yes,
just so they know.
yes. And this is why I've become more active. Is next year there's a form coming out. It's form 1099 DA, digital asset, and anyone who owns some type of crypto through an exchange, um, the exchange will be sending you and the IRS a form saying, "Hey, this is how much crypto you held. This is how much you sold." Basically, like a 1099 that you would get from like any brokerage, like Vanguard. So, in most cases, people voluntarily disclose their crypto gains and tax, but now your broker is going to be snitching on you to the IRS.
And snitches don't get stitches in this world. That's not how it works, right? They're not. You can't do anything to them. That's just how it's going to go.
Oh, okay. So this is what I would say to my crypto investors: it's fine, you know. Um, the only issue is that because this is the first time that they're doing this next year, there might be a lot of mistakes. So don't assume that your Form 1099 is correct. Okay. And don't assume that the tax based on your Form 1099 is necessarily the tax that you have to pay. Go through your transactions, make sure you have recorded everything, and then, if you're audited by chance, we have all the documents. We can go to the IRS and we can correct them and educate them.
Okay, well, I love bringing value to owners because that's what I love working with. So once this forum comes out, you start to see some of the stuff. I'd love to get you on just talk about that because there are owners who would never sell for Bitcoin, but they have it, and so they might see some of these issues that you talked about. So hopefully early next year we can get you on to hear your thoughts on that because I'm sure it's going to be the wild, wild west for some people.
It's going to be fun.
Okay, thank you so much for your time today, Rita.
Thank you, Ryan.